Now is year zero. You're considering opening a new concept restaurant. Last year, you have hired a consulting company to help you evaluate your business idea. The consulting company charged you $125,000 and turned in the following operating projections for the next 10 years. Annual revenue is expected to be $270,000 and will start in year one. Annual expenses will also start in year one and are expected to be $130,000. In year zero, you will make capital investments, which primarily include restaurant equipment, totaling $650,000. This equipment will be depreciated using straight-line depreciation method over the next 10 years. The appropriate cost of capital is 10%, and the current tax rate is 21%. Your goal is to determine whether you should open this restaurant or not. Let's solve this question. We are asked to evaluate whether we should open the new restaurant. To make this decision, we should use the net present value rule, which states that we should invest if the net present value is positive. The net present value is defined as the sum of project's cash flows discounted to present using appropriate discount rates. Therefore, to compute the net present value, we first should compute project's cash flows. Cash flows are defined as 1 minus tax rate times operating profit minus capital expenditures plus tax rate times depreciation minus change in working capital. Tax rate times depreciation is known as the depreciation tax shield, which arises due to the fact that depreciation is a tax-deductible expense. Notice that in this question, we are not given any information regarding working capital requirements of running the restaurant. Therefore, we will assume that changes in the working capital are zero. In this case, cash flows can be computed as 1 minus tax rate times operating profit minus capital expenditures plus depreciation tax shield. Let's record all of the given information into the spreadsheet and use it to compute the net present value of this project. Consulting fees are $125,000. Annual revenue is $270,000. Expenses are $130,000. And capital expenditures, which I abbreviate here as CapEx, are $650,000. Tax rate is 21%. Cost of capital is 10%. The question tells us that the restaurant will start generating revenue in year one, and that this revenue will continue every year from year one until year 10. Expenses also start in year one, and similar to revenue, they continue all the way through year 10. Now, knowing revenue and expenses, we can compute operating profit, which equals to the difference between revenue and expenses. So therefore, every year from year 1 through year 10, operating profit equals to $140,000. Now next, we need to compute annual depreciation expense. The question tells us that capital assets will be depreciated using straight-line depreciation method over the next 10 years. So therefore, to compute the annual depreciation expense, we're taking capital expenditure and we're dividing it by 10. So therefore, every year, depreciation expense would equal to $65,000. Capital expenditures occur only in year zero. That's when we buy restaurant equipment. Now, knowing operating profit, depreciation, and capital expenditure, we can compute after-tax cash flow. Recall that by definition, after-tax cash flow equal to 1 minus tax rate, which is 21% in this case, multiplied by operating profit minus capital expenditure plus depreciation tax shield, which equals to the tax rate multiplied by depreciation expense. And so in year 0, after-tax cash flow equal to negative $650,000. In all of the subsequent years, in year 1 through year 10, after-tax cash flow equals to $124,250. Now, the final step to compute the net present value, we need to discount all of these cash flows to present. To discount these cash flows to present, we're taking the cash flow and we're dividing it by 1 plus cost of capital raised to the power, which equals to the year when this cash flow occurs. So these are the discounted cash flows. And the net present value simply equals to the sum of the discounted cash flows. So the net present value here equals to $113,462. Now, what about consulting fees? Since we paid these fees last year, they are sunk, and we should not take them into account when making our decision whether to open the restaurant or not. Since the net present value is positive $113,462, we should go ahead and open the restaurant. Now, let me also teach you how to use the NPV function in Excel to directly compute the net present value. The function NPV takes the first argument as the discount rate, which in our case is the cost of capital. And the values are all of the cash flows that start from year 1 onwards. So remember, because we're using NPV function, we're just taking the cash flows that are not discounted. So the function will discount these cash flows for us. If we also subtract the initial investment of $650,000, this calculation should equal to the net present value, which we computed by just summing up the cash flows that we discounted ourselves. So the two results are identical. You might have thought of a more compact way of solving this problem. Since every year, starting in year 1 and ending in year 10, revenue, expenses, and depreciation expense are constant, after-tax cash flows have to be constant as well. They equal to 1 minus tax rate, which is 21%, times operating profit, which is $140,000, plus depreciation tax shield, which altogether equals to $124,250. We can compute the present value of these cash flows from year 1 through year 10 using the annuity formula as follows. $124,250 divided by 10%, which is our cost of capital, multiplied by 1 minus 1 divided by 1 plus 10%, again, our cost of capital, raised to the power of 10, which equals the number of periods. This equals to $763,462. Given the initial investment of $650,000, the net present value equals to $113,462, exactly the number that we obtained before. Notice how much faster we were able to solve this question by utilizing the annuity formula. Keep this in mind and use this approach whenever possible, especially on the exam. Cybervision, a computer vision startup in Cambridge, Massachusetts, considers opening a new division to explore viability of a new technology. To evaluate this decision, Cybervision first needs to forecast working capital needs for the new division. Its chief financial officer developed the following projections in thousands of dollars. Accounts receivable are expected to be $0, $50,000, $60,000, and $75,000 in years 0, 1, 2, and 3, respectively. Inventory is expected to be $120,000, $150,000, $200,000, and another $200,000 in years 0, 1, 2, and 3 respectively. Accounts payable are expected to be $40,000, $40,000, $80,000, and $100,000 in years 0, 1, 2, and 3 respectively. Calculate the cash flows associated with changes in working capital for the first 3 years of this investment. This question is designed to help us understand the impact of working capital requirements on cash flow. First, let's use forecasts of accounts receivable, inventory, and accounts payable to compute net working capital in each year. By definition, net working capital equals to accounts receivable plus inventory minus accounts payable. Therefore, in year 0, net working capital will equal to 0 plus $120,000 minus $40,000, or $80,000. In subsequent years, in years 1, 2, and 3, net working capital will equal $160,000, $180,000, and $175,000 respectively. Now, recall that it's not the net working capital itself, but rather changes in net working capital is what affects the cash flow. So let's compute increases in net working capital each year. In year 0, this increase is just $80 because we go from 0 up to $80,000. In year 1, this increase would equal to $160,000, which is the level of net working capital in year 1, minus $80, which was the level of net working capital in year 0. So this is the increase of another $80,000. In year 2, net working capital increases by $20,000 from $160 to $180. And in year 3, it decreases by $5,000 from $180 down to $175. Now, the final step is to compute the associated impact of increases in net working capital on cash flow. Recall that by definition, cash flow equals to 1 minus tax rate times operating profit minus capital expenditures plus depreciation tax shield minus change in net working capital. Therefore, the cash flow will be of the opposite sign from increases in net working capital. So in year 0, cash flow is going to be equal to negative $80,000. In year 1, it will also equal to negative $80,000. In year 2, it will equal to negative $20,000. And in year 3, it's going to equal to positive $5,000. Now, let's try to understand the intuition here. Why in year 1, we have a cash outflow of $80,000? Well, let's look at the components of net working capital. Accounts payable don't change. They remain at $40,000. But accounts receivable go up from 0 to $50,000, and inventory goes up from $120,000 to $150,000. Therefore, it's this build-up in receivables and inventory that causes an outflow of $80,000 in year 1. Let's reconsider the restaurant project we studied in question 1. Suppose that to run the restaurant, you need $190,000 each year in net working capital. This working capital consists of food and beverage stock and the associated supply chain needed to produce and serve meals. You're required to make this investment in year 0. In year 10, you expect to close the restaurant, at which point the net working capital will go down to 0. Does this change your decision on whether you should open this restaurant or not? Let's add net working capital requirements to the restaurant project we considered in question 1. To run this restaurant, we're required to have $190,000 in net working capital each year, starting in year 0 and ending in year 9. In year 0, we will close the restaurant and the working capital will go down to 0. Let's start by adding these requirements to line 6 in the spreadsheet. In year 0, we're required to have $190,000 in net working capital. These requirements are the same all the way through year 9. And in year 10, since we're closing down the restaurant, the working capital goes down to 0. Next, we compute year-over-year changes in net working capital. So in year 0, we'll assume that before year 0 we had nothing in net working capital. So therefore, since the requirements in year 0 are $190,000, our increase is $190,000 in year 0. In subsequent years, we're computing the increases by taking the difference between this year and the previous year. So for example, in year 1, the increase in net working capital is 0 because the net working capital requirements are the same in year 0 and year 1. So the increase will be 0 all the way through year 9, and in year 10, the working capital is going to decrease by $190,000 because the net working capital requirements in year 10 are $0, and in year 9 they were $190,000. So therefore, the net working capital decreased by $190,000 between year 9 and 10. Now, in line 8, I will use the definition of after-tax cash flow to compute after-tax cash flows every year. By definition, it is 1 minus tax rate. Recall that the tax rate is 21%, multiplied by operating profit minus capital expenditures plus depreciation tax shield, which is computed by tax rate multiplied by the depreciation expense, minus increase in net working capital. And so in year 0, the cash flows are negative $840,000. In all of the subsequent years, these are the after-tax cash flows. Note that in years 1 through year 9, the after-tax cash flows are exactly the same as we had in question 1. In year 10, however, the after-tax cash flow is higher by $190,000, so this is the amount of the decrease in net working capital. As the final step, I will compute the net present value of this restaurant project. I will use the NPV function. I use the cost of capital, cash flows from year 1 through year 10, and I'm adding up the after-tax cash flow in year 0. And the net present value is negative $3,284. Turns out, net working capital requirements make the NPV of this project negative, and therefore we should not open this restaurant. Conceptually, it is the timing of cash flows associated with working capital that makes such a significant difference in this case. We're required to spend additional $190,000 in year 0, which we only get back in year 10. Given the discount rate of 10%, the time value of $190,000 is significant enough to turn the NPV of this project negative. You're considering a project that requires immediate investment in year 0 of $37,000. You expect that it will generate $20,000 in year 1, $15,000 in year 2, $10,000 in year 3, and $2,500 in year 4. The first question asks, what is the payback period of this project? Well, let's solve this question. By definition, the payback period is the amount of time it takes to pay back the initial investment. In our case, the initial investment is $37,000. In the first year, the project returns $20,000, which is less than the initial investment. Therefore, this project does not pay back our initial investment within 1 year. In the second year, the project returns $15,000. Therefore, during the first 2 years, the project returns $20,000 plus $15,000, which equals to $35,000. This is still less than $37,000, which means that the project does not pay back the initial investment within the first 2 years. In the third year, the project pays off $10,000. Therefore, during the first 3 years of life of this project, it returns $20,000 plus $15,000 plus $10,000. Altogether, this equals $45,000. Now, this is more than the initial investment of $37,000. Therefore, the payback period of this project is 3 years because it pays back our initial investment within the first 3 years. The second question asks, if you require a payback period of 2 years, will you take this project? Let's solve this question. If you follow a payback period rule, then you only take projects that pay back within 2 years of initial investment. In part A, we computed the payback period of the project under consideration. This payback period was 3 years. Since this project pays back within 3 years, and you only take projects that pay back within 2 years, you will not take this project. Third question. What is the net present value of this project if the cost of capital is 12%? According to the net present value rule, should you take this project? If the cost of capital is 12%, the NPV of this project is as follows. Negative $37,000, which is the initial investment, plus $20,000 that we receive in year 1, discounted to present, plus $15,000 that we receive in year 2, discounted to present, plus $10,000 that we receive in year 3, discounted to present, and finally $2,500 that we receive in year 4, discounted to present. Altogether, this equals to $1,521.65. Since the net present value of this project is positive, we should take this project. Now, let us pause and think. Payback period rule tells us not to take this project, while the net present value rule says that we should take this project. Recall that following the net present value rule is always optimal because it increases the value of the firm. Therefore, by following the payback period rule in this case, we would have made the wrong decision and would not have increased firm value. Let us summarize this lesson. Payback period rule can lead to wrong investment decisions. This happens because 1. Payback period rule relies on ad hoc decision criterion. Why we decided to take projects with payback period of 2 years or less and not 3 years or 4 years? Who have made this decision? There are clearly no good a priori reasons for this decision. 2. Payback period rule ignores cash flows that occur after the payback period. In our case, this project returns $10,000 in year 3 and $2,500 in year 4. By following the payback period rule with cutoff of 2 years, we're ignoring these cash flows. As shown by NPV calculation, these cash flows clearly make a difference in this case because the net present value of this project is positive. And 3, payback period rule ignores project's cost of capital and time value of money. Consider a project that requires an investment of $30,000 in year 0. This project is expected to generate cash flows of $4,600 over the next 10 years. What is the internal rate of return, or IRR, of this project? First, let's learn how to build an NPV profile for a given project. By definition, NPV profile is a graph of a project's NPV over a range of discount rates. In our case, if the discount rate is R, the net present value of this project is negative $30,000, which is the initial investment, plus $4,600 divided by R multiplied by 1 minus 1 divided by 1 plus R raised to the power 10. Here, we are using the formula that computes the present value of an annuity that pays $4,600 each year for 10 years, starting in year 1. Now, let's use Excel to compute this NPV for a range of discount rates R. In the spreadsheet, I have built an array of discount rates starting from 0.25% all the way to 15%, with increments of 0.25%. Now, for each of these discount rates, I will compute the net present value of our project. So starting for 0.25%, the net present value equals to the initial investment plus annual cash flow divided by this discount rate multiplied by 1 minus 1 divided by 1 plus discount rate raised to the power 10. So in this case, if the discount rate is 0.25%, the net present value of our project is $15,374. Now, let me fix the cells B3 and B4 so that I can stretch this array all the way down. And it will automatically compute the net present value of this project for all of these discount rates. Now, recall that by definition, NPV profile is a graph of a project's NPV over a range of discount rates. So let's plot NPV against discount rates. I am going to select both arrays and build this graph. What we see is that for this project, the NPV profile is a convex downward sloping line. It intersects x-axis around 8.75% mark. Recall that by definition, the internal rate of return, or IRR, is the discount rate that makes NPV of the project equal to 0. Therefore, the major benefit of building the NPV profile is to gauge what is the internal rate of return for a given project is. In our case, internal rate of return is somewhere around 8.75%. Note that this is not the exact solution yet. We will learn two ways of finding the exact solution for the internal rate of return now. The first method of finding the internal rate of return is to use goal-seek function in Excel. This function numerically solves equations. To use this function, we need to compute the net present value of a project for any given discount rate. This initial discount rate is often referred to as an initial guess. So I will set it to 0.25% and let's compute the net present value for this initial guess. Net present value equals to the initial investment amount plus the annual cash flow divided by the initial guess multiplied by 1 minus 1 divided by 1 plus discount rate raised to the power 10. So if the discount rate is 0.25%, the NPV is $15,374, same as we had before. Now, let's use goal-seek function. We're going to Data tab, What If Analysis, goal-seek. Goal-seek allows us to vary or to find the discount rate that would set the net present value to any value that we want. Now, since we're trying to find the internal rate of return, we want to set this cell, D9, where the NPV is, to 0 by changing this cell. So we want to find the net present value that would equal to 0 by changing the initial guess that we set for a discount rate. When we press OK button, Excel solves this equation and finds the discount rate that sets the NPV of this project to 0. In this case, the discount rate that sets NPV to 0 is 8.64%, which by definition is the internal rate of return of this project. Goal-seek function is a useful tool that allows you to solve any nonlinear equation in Excel. The second method that we'll learn how to find the internal rate of return just simply utilizes the IRR function in Excel. To use this function, we need to enter all cash flows that our project generates. We'll start with the year 0, where we have the outflow of $30,000. And then for the subsequent years, from year 1 until year 10, our project returns $4,600 every year. Now, in this array, we have all of the cash flows that this project generates. To find its internal rate of return, we use IRR function. So we type IRR, and then we simply select the entire array in which we have our cash flows. There is a second parameter that is required for the IRR function. It's an optional parameter. In some complicated cases, it does matter. In our case, it does not. We can put 0 here and hit enter. This function tells us the internal rate of return of this project is 8.64%. The same IRR that we got from using goal-seek function. The second part of this question asks, if the cost of capital for this project is 9%, should you take it? We have found that the internal rate of return of this project is 8.64%. Now, let's recall the IRR rule, which states we should invest only if the internal rate of return of a project is higher than its cost of capital. In our case, the internal rate of return of 8.64% is less than 9%, which is the cost of capital for this project. Therefore, we should not take it. To confirm, let us also compute the net present value of this project, given its cost of capital. If the cost of capital is 9%, the NPV of this project is negative $479. NPV of this project is negative, therefore we should not take it. Both IRR and NPV investment decision rules in this case agree. Rio Tinto is considering the development of a bauxite mine. Development costs are estimated to be $24 million in year 0. The mine will generate $4 million in cash flows over the next 10 years, starting in year 1 and ending in year 10. After that, Rio Tinto is planning to close the mine and to bring the site in compliance with environmental laws. The estimated costs of closing and compliance are expected to be $350,000 per year, starting in year 11 and continuing in perpetuity. Assume that the cost of capital is 8%. The first question asks, find the internal rate of return of this project. Should you invest in this project based on the IRR rule? Let's start by entering given information into the spreadsheet. In year 0, we have to spend $24 million to develop the mine. In years 1 through 10, the mine will generate $4 million per year. Starting in year 11, we have to spend $350,000 or $0.35 million per year in compliance costs. First, let's write down the NPV of this project as a function of discount rate R. It equals to negative 24 million, which is the initial investment, plus the second term, which captures present value of positive cash flows that the project generates in years 1 through 10. This is a simple annuity that pays 4 million each year for 10 years. The last term captures compliance costs. It is a perpetuity that starts in year 11. We can use the perpetuity formula to find its value in year 10, which is 0.35 divided by R, and then we discount this value to present. Now, to find the internal rate of return, we need to set this NPV to 0 and solve this equation for R. Now, obviously, we cannot do this by hand because this is a nonlinear equation of high dimension. We also cannot use IRR formula that we used in previous question because we're dealing with perpetuity and therefore cannot enter the entire stream of cash flows into an array. In other words, we just cannot enter an infinite array here in Excel. Therefore, we need to utilize goal-seek tool. Let's start with an initial guess for IRR, say 1%. Given this 1%, I will compute the net present value of this project. I will break down this calculation into 3 parts: the initial investment, the annuity part, and the perpetuity part. The initial investment simply equals to negative 24 million. The annuity part equals to 4 divided by R multiplied by 1 minus 1 divided by 1 plus R raised to the power 10. And the perpetuity part equals to 0.35 divided by R, and this entire expression is divided or discounted to present at discount rate R. Now, the NPV of the project is the sum of these 3 components. Now, to find the internal rate of return, I go to Data, What If Analysis, Goal-Seek. So I set the cell or the NPV to 0. Remember that internal rate of return is the discount rate R that sets this NPV to 0 by changing the cell of our initial guess. So Excel solves this for us and gives us the solution that the internal rate of return for this project equals to 2.48%. Now, given that the cost of capital is 8% and the internal rate of return is less than the cost of capital, the conventional internal rate of return rule would imply that we should not take this project. The second part of this question asks us to find the net present value and ask whether we should invest in this project based on the NPV rule. Well, the NPV of this project is simply this expression. It's the same expression that we just used to find the internal rate of return, but here we're just using the cost of capital of 8%. Turns out that the net present value of this project is $814,000. Therefore, Rio Tinto should go ahead with this project. This contradicts the answer that we received based on the internal rate of return rule. So what gives? To understand what's going on, let's build an NPV profile of this project. I have created an array of discount rates from 2% to 15% in 0.25% increments. For each of these discount rates, let's compute the net present value. I'm using here the same formula as the one we just used. I will extend this array, which will automatically compute the net present value for all discount rates that we have here. Now, what we see on the graph is the NPV profile of this project. Recall that in question 5, NPV profile was a decreasing function of discount rates. What we see here is a very different picture. NPV profile is first increasing and then decreasing in discount rates. We visually see that when discount rate is 8%, which is our cost of capital, the net present value of this project is positive, and therefore we should take this project. To understand why IRR rule gave us the wrong investment advice, recall the following. IRR rule can be used only when cash outflow occurs only in time zero, only one project is under consideration, opportunity cost of capital is the same for all periods, and the threshold rate is set to the cost of capital. In our case, cash outflow occurs in year 0 as well as from year 11 onwards. Therefore, we cannot use the internal rate of return rule to make an investment decision in this case. Let me make another remark. The NPV profile here shows that this project has two internal rates of return. The first one is somewhere between 2 and 3%, and the second one is somewhere around 9%. But when we used goal-seek tool, it gave us only one solution. The reason for this is the initial guess or the starting point. Our first initial starting point was 1%. And the numerical algorithm that solved this equation converged to the first solution here, which was 2.48%. But if we started from a different initial guess or initial starting point, anywhere to the right from this hump, say at 6%, we would have converged to the second IRR. To confirm this, let's go back to the other spreadsheet and use goal-seek tool with a starting point of 6%. So in this initial guess cell, I will put 6%, and I will go back to goal-seek tool, and I will ask it to set the net present value of this project to 0 by changing the discount rate cell. And if we solve this equation from a different starting point, we see that the algorithm here converged to the second internal rate of return, which is 9.04% in this case. The conclusion is that this project has two IRRs, and we can find both of them using the numerical tools in Excel. But what's more important is that we cannot use the internal rate of return rule to make the investment decision in this case, because the conditions under which we can use the IRR rule are not satisfied. Namely, in this case, we have cash outflows that occur after year 0. In particular, the compliance costs that start in year 11 and continue onwards.